All right, good evening, guys. Ken at Tortoise Capital, nightly strategy podcast for September 7th, 2021, Tuesday night. So let's see what we had today. All right, I'm feeling the RL10 rolling over here. The 3-period hole is sloping downward. The RL30 is still strong to the upside, and we have a crossing here of the RL10 crossing the baby dragon. So that's kind of like the first warning shot for what could end up being an RLXD if it falls below the edge of the river and the skin of the dragon. I took exits today at that price level right there. I'm not willing to let this thing go all the way back to the Bollinger Band mean at 445. And this feels like a nice leg one, big leg two after the bounce, and then leg three, and some topping action. And the reversion to the mean is always the least surprising move. And so one way to look at that is, you where is it going to meet the mean? Well, the Bollinger Band mean is going to do this, roughly, right? And so if it falls at the pace of the 3-period hole, then you would expect within the next 5 days or so that this thing could move back and meet the Bollinger Band mean at 448. So really, I was giving it this much room from the swing high, and then the exit here preserves a move of approximately twice that, maybe 3 times that. All right. So as I'm managing that exit, I'm making estimates of, where the reasonable moves could be, and what part of the move is mine, and how much am I willing to give back to give it some room to breathe. Now, I'm still ready to get back in. All it has to show me is a breakout above, I'm going to say, the RL10. That could get me long, and certainly above the all-time high would get me back in. But we've got that much room that it has to recover. That's about 1% that it has sold off from that swing high. So I'm mindful of the risk on this one. But that's been a pretty good move from the last 30 days. I mean, if we take a look at the 30-day low, which is pick your 30-day low, from 436 to 454 is plus $18, and that's about a 4% move. So giving up 1% preserves, giving up 1% here preserves 3% of the downside, or against giving back an additional 3%. All right, so but everything else still looks good. I mean, if this finds support here, or above the edge of the dragon, the edge of the river, that would not be surprising if it did this. That would be a reasonable, buy on dip. So we're going to watch to see where the support level falls in. For me, if it supports at 450 or higher, then then this long-term trend is still intact. But once it kind of breaks below the edge of the river and is back between Z1 and Z0 in this zone in here, that's a real weakening. And it wouldn't be surprising to see that. Like, I'm not willing to, in the interest of maintaining a position in a bull market, I'm not willing to give back that much to get almost to the bottom of the river and then return, because I can take those exits up in here, and then I know how to re-enter after oversold conditions, and so I can exit here and then enter here, and I've made that difference right there in terms of swing trading. So that's my thoughts on this one. All right, let's take a look at the sectors. Starting off with our 6 sectors, big sectors in yellow. So the S&P was down, excuse me, 0.36 today. The Qs were up a fraction at 0.14, and the emerging markets at 0.58 for the win. Then a cluster of weakness here in the rest of the U.S., though. All 3 of the other U.S. indices were down. The Russell down 0.7, the Dow, troublingly, down 0.76, and then Treasuries down 0.84. They are now coming within, danger close of 145, that key price level. We've been watching the Treasuries working in $5 increments from about 130 northward, and each $5 gain has been like one more step up the ladder. And it got above 150, but has now come back $5 to almost, in order to start testing support at 145. So we're going to see what, excuse me, what kind of long-term strength Treasuries have as a defensive play, particularly if this is an area where the market starts rolling over. Will Treasury step up and become a defensive play, or do we have to look elsewhere? The emerging markets are raising their hands, saying, hey, don't forget about us, because they made money today too. All right, so let's take a look at a couple trade reports from the boys in the chat room. Excuse me. Yeah, I screwed up the recording yesterday, so actually let me cover the trade histogram from Nigel again, because I thought he did such a nice job on that. I'd like to actually get that on tape. Right. And what Nigel has done here is prepared a histogram that covers 200 trades that date back to starting the Foundations course. So he's been learning by doing. And there's some really good work in here that I want to acknowledge. First of all, I want to take a look at the histogram. And here's the zero line right here. Right. So that's the zero line. And the first thing that I check to see is are there any losses greater than 1 R? And there are not. So after 200 trades and no loss greater than 1 R, we have some evidence to say that Nigel is capable of identifying a manageable 1 R execution risk and then not exceeding that. So that means that we can reasonably say that he can estimate the manageable risk. And the second thing that I look at is between -1 and +2, which is right here. Does this have the shape of a normalish kind of curve, and is it positive expectancy? And it is. And this says that we have a lot of trades that are falling into this normal range, standard management. And so that means that there's a lot of things that if we can just get a 0.25 R improvement on a quarter or a half of those trades, we can move the entire mountain to the right a quarter of an hour, and that's going to be a very positive impact on the overall bottom line. And then the third thing that I'm looking for is the possibility of fat right-hand tail. So he's controlled the left-hand side of the curve beautifully, and he's open to a number of trades that are better than 2-to-1. And so that really reflects all of these that are north of that 2R line. So that's good. He's got a fat right tail. So all the three things that I'm looking for in the histogram are present. So that's very good. Excuse me. The average rolling R in the first set of 100 stabilized around 0.1. And the second, now if you discount this first set of anomalies in here, this line would actually settle in right about here, which is at about 0.12. And that's excellent because we're seeing an improvement in his long-term expectancy, the stable line of at 0.12. And you see that on this one too. So the overall one is around 0.11. Sorry, and then trades 1 to 100 was 0.12, and then trades 101 to 200. Correction is upwardly mobile. So that's improving, and it's north of 0.15. That's what I meant to say. So an improvement of 0.03 in average expectancy is actually a 25% improvement of performance. So when you go from 0.12 to 0.15, that's a 25% improvement in the long-term rolling R and expectancy, and that is a very favorable sign. That is evidence of stable, consistent, long-term improvement in all his processes. And then you see that reflected, the overall positive expectancy in this stable rising equity curve, and the fact that each of the pullbacks are having higher lows. Now, if we saw a price move like that, we would say that is bullish and would favor the Kata 2 kind of trading, that we want to trade a system that has lots of opportunities that gives us those kinds of statistics. So if we take a look at the 200 trade frame, let me increase this a little bit so you can see the numbers, because we're going to come and look at this a little more closely. All right, so now we're looking at the 200. Get my little pencil drawing here. Okay, so in the first 100 trades, what he had was, let's see, 27 wins, 43 losses, and it paid $1.04 and lost minus 0.45. So now if you were to roll in the scratches, what you would have is about a 57% win rate that paid a little bit. It paid like 5-4, and that's not bad. It has a positive expectancy, and that's pretty good. But if you look at the second set of 100, what he has improved this. Now if you add those two together, you get 53 out of 100. So that's a win rate of about 0.53. But then now when you add in the scratches, you got to take about half of that average win. The average win is now about 0.76 to 0.47. So that's a coin flip that pays 3-2. So if you were Las Vegas, you would love those odds if you were on the side of the house right there. And you could ask yourself, what if you could flip a coin if you could play a game where you flipped a coin and heads you win 3 and tails you lose 2, how many times a day would you want to trade that? You'd want to trade all of them at the lowest level of risk that allows you to still achieve your long-term financial objectives. You would want to get the expectancy of that system. And now notice that his SQN has improved from 1.2 to 1.99, and that's very good. And then if you take over 200, the SQN starts increasing because the size of the n, remember you take square root of n when you're computing system quality number, and that's why when you start getting large data sets, the confidence that you have a stable system starts to increase. So what we're seeing here is actual genuine evidence of improvement over time. So well done. Well done. This is what management looks like. So you've heard me say in the Foundations course before that there was something about 600 trades or 800 trades really seemed to make a difference, that people that have done that many have suddenly kind of, not suddenly, but they have internalized the habits of mind and developed unconscious competence. And that's what skill is muscle memory. So, and then I'm noticing that he's identified, the patterns that he's using, and this is very good because the collapsing dragon for down markets is 40% of the time, and then the up markets, the SSC and the K2 and emerging dragon is about 41%. That's good. And then he's got the special case, the Z3P, only about 10% of the time, and that leaves about 9% for other things that aren't technically those. So he's specializing in the basic patterns of the Foundations course, and that's very good. And he's getting about half his opportunities to the downside and half his opportunities to the upside. And I'm going to guess that the Z3Ps are probably equally split. So what that means is that he is not having a directional bias, that he's willing to frame the trades and take them in both directions. The next step would be to compute the expectancy of the individual patterns and then decide whether or not the short side or the long side is really favorable. But I'll tell you, with this kind of improvement, and even with those kind of stats, just on the final, the second set of 100 trades, you don't mind taking that for the long term when you get plenty of opportunities every day, and this works across multiple different market types. So just +1 to Nigel for doing the hard work. This is what preparing to win looks like. Everybody wants to win. Not everybody wants to do the work that it takes to set yourself up to win. So +1 to Nigel for doing the work. Well done. All right, here's an Alcoa trade. The COTA 2 entry is a little bit, I'm not going to say it's late. There was a move earlier in the day that was available, but you got to be willing to play the hybrid. That's a hybrid frog trade in here, or an opening range 5 when you get that 5-minute bar and then it breaks out after a gap up. That was possible with an exit in here. That's a reasonable effort at COTA 2. That's a great exit. I'd like to see the entry maybe a bar earlier there as it crosses the VWAP, but I don't mind. That's pretty close, and that's a reasonable fractional loss. But man, boy, do we got to hit that one. Woof. Because we've got the swing high in the dragon, we've got a lower high, and it rejects at the VWAP and is coming down to close the gap. Here was yesterday's VWAP, and when the upside move fails and starts to roll over, yesterday's VWAP becomes a very important target level. And look how long it stayed in that vicinity. This entire move through here is a reflection of yesterday's VWAP where it finds support. So that was the move we wanted. This is still, that would be a good second position if we'd hit the first one. So if we'd have gotten this first one in here, that's a reasonable second position. And then if you're going to take that one to cover, then you got to be that aggressive and get back short again here instead of here. And that would turn this one into a fractional gain instead of a fractional loss. This is a really good entry because now you're into the day and it's finding support approximately at yesterday's VWAP, and there was already buying support to take it from that VWAP down here to this VWAP. So this is a reasonable shot at getting back to here, and he gave it 10 or 15 bars, and that's a fractional loss, and that's legit. This one just didn't follow through, so there just wasn't much after this first move and after the big move, and it just kind of locked in. There just wasn't much more to get in that day, and the rest of the day is kind of a grind. So I like the learning lessons that he's showing here. He's reading the chart, looking at his own trading through a coach's eye. So I think that's really good form, and I think that's well done. This is Luke with CLF here. Let's see what we got. And this is CLF on a 600 tick chart. A reasonable effort after yesterday's close right in here and a little bit of a gap up and go. That's a good shot. On this one that is running up near Z3 and then can't hold, this would be the 1, 2, 3 exit, which would make this a scratch. That's not that much to give back. I'm not really offended at that. This is a really good, a price level, a good re-entry. I think this gives back too much. So if we're going to lose, if we're going to give back that much here, then let's be a little bit tighter down in here. This is a good second effort as it rolls over. This might have been taken a bar or two earlier, but that's still reasonable. This is a good COTA 2 and a breakout from the Z3 pinch. I think we got to get that exit here instead of waiting for it to come all the way back to the VWAP. But that's still pretty good. There just wasn't much movement in that one, and you got the piece that we wanted, but we just got to tighten up that exit there a little bit. So that looks pretty good. Just want to make sure there's nothing else. You guys didn't sneak any other ones in there on me today. Nope, that's it. If you post them, I will comment on them. That's you're making it easy for me to do work if you do that. Okay, so today all right, so we have started to sneak into we've come out of the oversold condition or overbought conditions. We're still in bullish normal. The risk on trade is still there. We're only 1% away from the swing high, but we're coming into a critical state. When you see the volatility tightening up in here, that generally means we're prepping for a bigger volatile move out of the volatility compression, and that's another reason to start raising cash right now. Plenty of dojis today in the Dow, and that is unsurprising that when you see that, you'll also see a number of channelings where we're in the third day of the pullback, so things are starting to get into oversold conditions. We still haven't made any new breakouts high or low, and we have a half a dozen auto framers that look reasonable. In the ETF 30s, 5 dojis, only a couple auto framers, and XLF almost broke into a new 10-day low. That's the only one that's really testing the downside right there. So I would watch for some more weakness in the financial sector right there. That also, however, leads you to a critical state where the channeling and overreaction can work. So finance would be on my short list of things to be prepared for. The auto framer, there's not that many to pick from, but I kind of like American Express in the financials and materials based on the weakness that we saw in Cliff and Alcoa today. So I'm going to be ready to stock that one for a rebound. In the daily squeezes, you have materials and consumer staples, or I'm sorry, consumer discretionary, are postured for a nice move. And SPY is still pretty close at 1.9 to start building for a bigger breakout. We're still being dominated by spring and summer in the ETFs, but the Dow is already showing more weakness and has a lot more things in the fall than the ETFs do. So the Dow, the conservative large caps, are starting to suffer a little bit more than the rest of the broad market. Today, just when you compare how much green and yellow there was on the 2 and 10 day, you can see that there's actually quite a bit of broad weakness compared to just a couple isolated pockets of gains today. And that's my takeaway, that the upside strength of the market is getting narrower and narrower. And so we're going to want to be playing some short-term defense here, and make sure that you've got good stops being managed inside your swing trades, and raise some cash for some opportunities that are going to be coming in the next couple of days. All right, that's everything I got for us here. We'll get this published and posted. And remember, post your charts when you're ready for the feedback. That will be the single best thing that you can do to improve your technique. And looking forward to our work tomorrow and see what comes next. So take good care, and we'll see you tomorrow.